Hello friends, welcome back to part 25 of my Tesla earnings forecast video review series. I am joined, as always, by my co-host, Loki, who doesn't even know that it's a Breakfast with Loki episode, but it is. Breakfast. Yes. There's your breakfast, buddy. Okay, we'll see if Loki wants to eat his breakfast. He's sniffing. He's sniffing the air, that's a good sign. I'll set a couple of kibbles right there and see if we can get him interested in his breakfast, and while he decides whether to eat it now or later, I will share my desktop and continue the tour of my forecast model, my detailed model tab of my Tesla earnings projection model as shared on May 7th in a 69 tweet thread. So where we left off, I had just covered stage 2 of my detailed build up to my forecast, which is the revenue per vehicle section. What comes next? We got to figure out cost of sales. So the first section, or stage 1 of my build up, figured out by model, by site, how many of each vehicle Tesla would produce and how many of each vehicle Tesla would sell. So that gives you your units, that's your volume. The next piece you need to know to forecast revenue is, okay, at what average revenue per vehicle? So we did a very detailed build-up to what those average revenues per revenue type would be by model and by site, by option. So now what we need to do is figure out, okay, how much is it going to cost Tesla to build and deliver those vehicles to their owners on average. And what we're going to do is exactly the same thing we just did with the revenue. We'll just be doing it for cost of sales. So if the format looks the same as stage 2, that's because it's exactly the same. We're just doing cost dollars now instead of revenue dollars. So instead of how much revenue does Tesla take at the time they sell these configured vehicles to their new buyers, we're answering the question, how much will it cost Tesla to produce and deliver these vehicles to their proud new owners? And the first section here is the Model S. So Model S is only made at Fremont. Here's the assumption I have in for Q1 on how much that vehicle cost to produce. I've got that improving some, less than $1,000 here, and then a little bit more improvement in Q3 and Q4 as Tesla is able to just generally drive the cost down some. In Q1, they probably weren't able to make lots of progress on cost savings because they didn't sell that many vehicles, but I'm forecasting that they will sell about twice as many S and X vehicles in Q2, so they should have some gains from efficiency on delivering more of them. The average cost per vehicle will come down a little bit. Paint is about $700 per vehicle worth of cost in most of these. That's a small consideration. Performance package, I've got, about $3,300, $3,250 forecast this year for the Plaid Model S, as fewer people are going to buy that during a bear market or a recession than would when it was, fresh out of the Plaid refresh. Probably. Then we've got wheels here, interiors, and full self-driving. I know the interior doesn't cost $150. This is the markup versus the base. The base already includes a cost of interiors. This is just the additional cost or the incremental cost of making the non-standard interior, the premium interior, which is the white interior. And then for full self-driving, I've got some costs per vehicle here, not because if you were to take all of the costs of the FSD program and divide them by the deliveries, it would be $100, but because a lot of those costs are recorded as research and development costs, not as cost of sales. So this is really just a placeholder to have some cost, so we're not showing 100% flow through on the revenue, per vehicle for full self-driving. So that gets us to the cash buyer cost of sales, or the costs that go with the options that a buyer sees when they configure their car. But we're not done, for the same reason we weren't done in the revenue section. At the cash buyer revenue line, we have some adjustments to make, and those are for leased vehicles. Actually, there's no adjustment needed for leased vehicles here, because it does cost you just as much to deliver a leased vehicle as it does to deliver a vehicle to a cash buyer. The difference is that Tesla gets the leased vehicle back after 3 years and is able to sell it. So this is one of the reasons why, even though the cost of sales percent is better on leased vehicles, you don't want to do only leased vehicle sales, because you would have to be financing your own building and delivery of those vehicles without getting cash on the barrelhead on the date of delivery. So tough to manage your working capital if the leased mix gets too high. So that's why Tesla tries to price the leasing high enough that it's a small percentage of buyers who opt for it. But in some cases, some corporations will pay managers a portion of their salary as a car allowance to lease a vehicle. So especially in Europe, it's very popular for people to have a company car on a lease. So destination and delivery fee, I've got some cost in here. I mean, arguably it's higher than this, but this is just a placeholder for a very tough to nail down cost, right? Cost could be less if you're very close to the factory, right? Or a lot higher if you're in a very hard to get to location. Regulatory credits cost almost nothing. There's maybe some processing work that you have to do. And then the other is everything else combined. So FSD deferred revenue might come with a little bit of cost. Over-the-air software upgrades might come with a little bit of cost. The data plan definitely does. Tesla has to pay for cellular internet for people who buy the internet connectivity package for their Tesla. So there is money there per vehicle. And that gets you to an adjusted total cost of sales per delivery. If you take the total automotive cost for Model S's and you divide them by the number of Model S's delivered, there's your total cost. Seems high. Seems high to me. But that's what's working in my model, if you want to know what my assumptions are. Cost of sales dollars for this model, $413 million back in Q1. We've got that rising to $876 million. Why? Because the deliveries are doubling. That's why, more than doubling for Model S's out of Fremont. It was a very low deliveries quarter in Q1. All right, so that's what's in my forecast here. You can see very similar numbers in for Q3 and Q4. I will monitor and adjust these forecasts over time. So now that I've introduced you to the concept of what's going on here, we'll go through these other ones faster. So Fremont Model X, extremely similar to Fremont Model S. Same kinds of assumptions going on here. I think Q1 was just an abnormally low quarter for performance package, and that it'll spring back a little bit, not to the same levels we saw last year, but some. Not really a lot else there to talk about, except this just coming back to a normal level of deliveries for the remainder of the year after a very low deliveries Q1, which does happen sometimes, right? You can go back and look at prior years and find plenty of other years where Q1 was the lowest quarter for deliveries. Okay, what about the Model 3s made at Fremont? Well, I've got those costs improving over time as well. Most of the action is happening in the base configuration line, so Tesla's going to be continuously improving their supply chain logistics and sourcing of raw materials and parts, trying to optimize for cost per vehicle delivered. Same kind of story here with the performance package. It was just low in Q1, and we'll come back. I've just got these pegged to a percentage of the revenue. So the revenue is what's driving these costs to do what you see here. Then we've got the cost of wheels, the cost of interior and seating configuration. Standard assumptions for the rest of these get you to these assumptions. So we ought to be seeing continued lower costs as we saw in Q1 for the remainder of this year, lower costs per vehicle than we saw last year. Then for the Fremont Model Y, very similar to the Fremont Model 3 kind of story here, a little bit of savings happening every quarter, not very much really, only about $1,000 total for the year on this base configuration line, with maybe not a lot else going on here, right? That's kind of the whole story. You know, you ended last year at almost 42,000, and I'm forecasting that we'll end this year at only a little over 41,000. These are less than $1,000 apart, right? So very stable Fremont costs per vehicle is what I'm forecasting. Then for Shanghai, these costs have been coming down, and I'm expecting them to continue to as they achieve better volumes. So it shouldn't be that hard for Shanghai to get a little bit more cost efficient at much higher volume in Q2 than we saw in Q1, and for that to sustain through the rest of the year. Not a lot of other action happening in the costs for the Shanghai Model 3. Let's look at the Shanghai Model Y. Those costs are also coming down, which is great for the world's best-selling vehicle so far this year in Q1 of 2023. Multiple news outlets are reporting that not only is the Model Y the best-selling luxury EV in the world, it's the best-selling EV in the world, and it's the best-selling car in the world. So you get all of those, outselling even the Toyota Corolla, despite costing twice as much as a Corolla costs for the base config. You can option up a Corolla. I don't know who would, but you can pay a lot for a Corolla if you want to. Let's see here. Yeah, so just expected better costs here than we saw in Q4 of last year. Really, just a return to some of the same costs that we saw last year, right? And maybe a little bit of further improvement from there. For the Shanghai Model Y, you can make them pretty cheap in China, a lot cheaper than you can make them in Fremont, of course, because wacky California labor laws, and you know, China's just very efficient on labor cost, especially, and with locally sourced supply of raw materials and parts. Okay, then to Berlin, should these be improving as that factory ramps up production? Yes, they should, a lot, which is what's in my forecast here. For the base config, that's where I've loaded the cost savings. On the rest of these lines, you see more stable amounts, maybe a little bit of efficiency gained on the performance package, but the rest of these, not really a lot of cost savings, most of the heavy lifting being done by the base config getting better. This is going to help Tesla's profitability, the more Model Ys they can produce out of Berlin. Also, some of these are just the cost of shipping is in here, shipping and logistics. I mean, I'm not carrying very much on this destination and delivery fee line. So most of the money Tesla is saving when they will need to export fewer vehicles from Shanghai to Europe, they don't have to pay for those ro-ros. That's an expensive cost to ship stuff halfway around the world. And when you have local production, you don't need to do as much of that. Maybe some of that is still going to happen. For the Model 3, it's still going to be happening. But for Model Ys produced from Berlin, most of those ought to be going to fairly close by purchasers. All right, so that gets you to significant cost improvement out of the Berlin Model Y. We're going to see a similar story from the Texas Model Y here. Yeah, ought to be a lot less expensive to produce those vehicles. from Austin by the end of this year than it was at the end of last year. Significant cost savings, just driven by increasing the production output quite a lot, and then dividing the labor cost by a lot more vehicles produced is how you get your average cost per vehicle down. Also, labor in Austin, not as expensive as Bay Area, California wage rates plus California labor laws making you pay salaried people overtime, etc. Weird California labor laws. Next, we got the Cybertruck here. There won't be any delivered in Q2. I did have a placeholder over here for it. They're going to be at very low production for the first couple of quarters. There may not be any in Q3 either. I do have a tiny amount forecast. You can see there's $12 million worth of total cost in Q3, $276 million in Q4. I'll go ahead and give you a sneak preview of what's happening next year, so you see that these are going to rationalize down to more normal costs per vehicle by the end of next year. But it's typical for car companies to lose some money on initial production when they're still at low volume. They're below the break-even output, and at that point, you don't make any profit selling those vehicles. That's how it goes. If you want to get into the auto business, it's one of the reasons why it's so difficult to get cash flow positive. Elon describes this problem a lot, that making prototypes is easy, but producing is hard. Producing at scale is hard to figure out all the logistics needed to make stuff, and the regulatory and everything else. And then getting cash flow positive is way, way harder than that, because there has to be a market for your product. A lot of people have to want to buy it in order for it to make financial sense for you to get more cash inflows than you have cash outflows. And Tesla has managed all those, and a lot of other EV startups have not. Here we have the semi section. Tesla doesn't even report the semi on their production and deliveries report because the delivery volumes are still so immaterial. These are the costs that I'm carrying for that vehicle. A whole lot when you first start delivering very small units to just one buyer, to Pepsi. Hopefully we'll see them scale up more semi-production. We're not going to see high volume out of this model until it gets moved to a different location. The Nevada test pilot facility can't make lots of semis. So if this is going to become a big money maker for Tesla, they're going to need to move to a purpose-built semi-production line that can make them at scale. And get these costs down to, $200,000 per vehicle instead of the $400,000 per vehicle they may have been running at lately is what I'm modeling. So once you've got all those, you can add them all up. So you've got the cash buyers cost of sales here, then there's the leased buyers cost of sales, and the total. Probably you care more about the total. So I'll just scroll down here and show you what those dollar amounts are in billions. These are not per vehicle. These are billions of dollars worth of cost. So yes, the cost is rising versus where it was in Q4 and Q1, but there's going to be more revenue. So the revenue is increasing by more than this much. So you should see some improvement in total automotive cost of sales as a percent of revenue, which is what you want to have your margins improve. Next, we've got the non-automotive cost of sales section. What am I doing here? Well, I have fun formulas in here that figure out how to adjust for the costs of solar panels or solar roof, Powerwall, Megapack, just showing some improvement over time on these. So for Megapack, I've got a forecast of an 85% cost of sales relative to the revenue. We saw the revenue calculation in the previous video, so I'm just taking 85% of that as cost in Q2. I'm calling out the Megapack specifically here because it is the main driver of the change in profitability in the Tesla Energy division for the remainder of this year. I mean, it was called out on the earnings call by Zach and Elon that this is the driver, Megapack is, of a lot more growth in revenue as a percentage than we're going to see from Automotive this year. And Automotive is going to grow substantially year over year. Even if it only hits the guidance of 1.8 million, and I think it's going to blow way past that and past 2 million as well before the end of the year. If Tesla can keep output high and keep deliveries high against that. So in Q3, I've got that improving to an 80% cost of sales on Megapack, so a 20% gross margin. And then in Q4 to 0.78, so 22% gross margin expectation by the end of this year. Zach said they're targeting mid 20% cost of sales, or gross margin, I should say, for Megapack. And that's where I have it scaling to by the end of next year. 25-26% gross margin in Q3 and Q4 of next year. I think there will be further improvement after that, so I've got this improving to 30% gross margin by the end of Q4 2025. That's because by then the Megapack factory in China should have ramped up to be helping out quite a bit, and the costs ought to be lower there than they are in California, where Tesla has the Lathrop Megafactory. Why say Megapack factory when you could say Megafactory and save yourself a whole syllable and amuse people? Okay, so that takes us to the total Tesla Energy cost of sales. The rest of these are pretty boring, what's going on here. Because the cost of sales rate is so high on them, I'm planning on a 98% cost of sales for these solar production items. And for Powerwall, really, to only improve itself by a little bit versus where we've seen their costs as a percent of revenue trend over the previous 4 quarters is what the formula is doing here. And then small amounts here for other energy cost of sales, including software as a service. You ought to have a pretty decent margin on that. So we've got a little bit of cost in here for that gets bigger over time. So cost of sales is increasing for Tesla Energy, but at a slower rate than revenue is increasing in my forecast. And if I'm too bullish on the revenue, I will make adjustments in my next forecast. I forecast twice per quarter, whether it needs it or not, unless my production and deliveries were both within 1%. In which case I reward myself by not reforecasting after the production and deliveries report came out, as I did in Q1. So that gets you to these total cost of sales dollars and total cost of sales percentages and gross margin percentages. So what's going on in total? Well, we saw 4 points worth of total gross margin decline in Q1. I have that bouncing back a little to 20% total gross margin in Q2, 21.5% in Q3, 22.5% in Q4. All of these are less than we saw at the end of last year, but prices were higher toward the end of last year before the discounting began in December in the US. Trying to get people to take delivery before the EV tax credit went into effect. Tesla was offering people $7,500 tax discounts, promotional discounts here in Q4. And I'll save the percentages for my next video because this video has been long enough at 24 minutes. So with that, I will check back in with Loki, who has opted to nap rather than eat. And I'll outro and say if you've enjoyed today's video, click the like button. And if you're not subscribed to my channel, why not go ahead and subscribe over here. You can also subscribe to me on Twitter for only 69 cents per week. That's a pretty good deal. Thank you to everyone who supports me, whether that's on Patreon or Twitter or on YouTube, especially my executive producers, Kathy Kitchler and Rebellionaire.com. And I'll see you in the next one.